We've closed out November on a much more positive footing following plenty of jitters over recent weeks around the tech sector. Instead, now we're seeing upside for many of the indices. We're also seeing the precious metals on the rise once again. And we've seen a UK budget essentially pass without any major jitters for the market. And so that leads us into December. Are we going to see a Santa rally take shape before too long? Who knows? But this is a video to prepare us for the first week of it, the week starting Monday, the 1st of December. So the top tier events that are going to happen over the course of the week kick off on Monday with a focus on China, the manufacturing PMI coming out alongside the ISM manufacturing PMI out of the US later on in the day. Remember, the ISM numbers are particularly interesting because they give you separate readouts according to different elements like new orders, but crucially prices paid. So you can track whether the manufacturing PMI or the services PMI has been driven by higher prices and lower output, in which case you've got a stagflationary picture, or whether you see the normalization of the two, because certainly that has been the case for a while now. Consumer confidence out of Japan, and in the inflation rate out of the eurozone. Wednesday, Australian GDP and the services PMI from ISM out of the US. Thursday, the balance of trade, so trade data out of Australia, the IV PMI out of Canada. And we wrap up the week with a jobs report out of Canada, no jobs report out of the US this time. But we do see the belated core PCE price index. So we do have plenty of interest at the back end of the week, in particular for the US. And let's kick off with the US. Of course, we more recently have been seeing a number of different Fed speakers coming out with a more optimistic tone when it comes to the possibility of a rate cut in December. And so, of course, they remain data dependent, and they are in a sticky situation where essentially they've got two different things that generally would move hand in hand, right? We don't necessarily see that this time around. We see a deterioration in both, right? We've got elevated inflation, which is typically something you see when the economy is running hot or when it's doing well. But we're seeing elevated inflation in the face of rising unemployment and a weak jobs market. And so members of the Fed essentially have to weigh up the two. Which one do they think is more problematic? Do they need to rescue the economy, or do they need to stave off inflation? And so you see different members thinking different things. And more recently, we have seen a couple of notable members from the Fed. Crucially, the Fed vice chair, which is Williams, he essentially alluded to the idea that they were going to cut. And markets have reacted in turn to that. And we've seen some weakness in terms of the US dollar. But of course, like I said, they're data dependent. So we need to see each data point, and we need to see whether it informs us about a potential change in that outlook or not. This week, like I said, we've got those ISM PMIs, which I think will be important. We have got the ADP payrolls numbers on Wednesday, and that has taken on a more prominent role recently given the shutdown. And then we've got the core PCE price index figure for September released on Friday. Remember, of course, this is a belated release, and that's why it's for September. So we are looking some way back, quite frankly. Some will say, well, you know, it's such a sort of stale reading that we don't want to pay too much attention to it. I would disagree personally. I think ultimately you're looking at a figure that plays into the wider picture in terms of whether price pressures are growing or not. And certainly with markets expecting a 0.2 reading, that would signal that inflation is under control and embolden those calling for rate cuts from the Federal Reserve. In terms of the outlook for inflation, you can see essentially the core PCE and the headline CPI figures just below or around that 3% mark. Of course, that's significantly higher than the 2% target they set at the Federal Reserve. And so you can see here that essentially we're on pace for the core PCE figure, according to the past 6 months, to get back to 2.5. So price pressures are still elevated, but you could say, look, if the economy is suffering and we're running at 2.5 or that pace, then it's not necessarily problematic. Maybe they don't necessarily need to get back to that 2% target per se if they're faced with troubles in the jobs market. But that's in 6 months' time if we carry on at the pace that we've been seeing over the past 6 months. And so we need to know whether that's going to come to fruition or not. You can see essentially this time around, Markets are expecting. Okay, we haven't got the headline core PC figure here. Let me just. Sometimes, for some reason, they don't actually include the annual change on the economic calendar, and you have to look into it separately. Okay, so markets are expecting a decline from 2.9 to 2.8. So yeah, that would likely point in the direction of a potential rate cut in December, and signal, in all likeliness, the possibility of further dollar weakness, further upside for equities. I mean, ultimately, I think it's important to note that whether we see a rate cut this time around or not probably isn't necessarily the be all and end all. Certainly markets act in that way because they just care about how quickly can we see rate cuts, and then markets will react quickly. So the 80% chance or 87% chance that you're seeing at the moment priced in for a rate cut is notable because that's been a significant shift of late. So we've seen significant swings. That was 95%, then it dropped down to 50-50, and now actually it was even less than that. It was in favor of a pause, and now we're back up to 87. So significant swings of late. And yeah, I think part of the big picture really for markets is going to be like, where do we stop? In actual fact, we have seen some shifts at the back end of this where you can now see that the long-term base case or sort of terminal rate is now 275 to 3. Not so long ago, that was just 3 to 325. So in my mind, it's not just about do we cut this time around or not, but also are we going to see more cuts beyond the so-called terminal rate? Like, where do we end up? Previously, people have been talking about 3. I think that's going to come into question, and you're seeing it a bit now already. You're starting to see that priced in because, of course, we're going to see a new Fed chair, and Donald Trump will be voting someone into that position or placing someone into that position that he thinks will do the job of driving down interest rates. And he thinks rates should be well below 3%, that's for sure. So quite how much influence they can have on the group remains to be seen. But certainly you've already seen Stephen Mirren coming in there and voting for 50 basis point cuts pretty much every single time. That's something. But when you've got a Fed chair doing it, then that suddenly takes on a sort of life of its own, and you do question whether this is going to massively impact sentiment. So let's look in terms of market moves around the Nasdaq. Excuse me, let's just jump on there. So okay, so here is the Nasdaq. So from a wider perspective, of course, we know it's an incredibly bullish trend that we've been seeing over recent years with this AI move, but we've seen this sort of 3-week pullback coming into play. People thought it was the end of the world. A lot of talk about the tech sector essentially just being a bubble that's about to pop. As anyone that watches our videos will know, I have said multiple times now that maybe it does crash at some point, right? But for one thing, I don't think all of these stocks are going to crash. I think some of them at some point will show that their investments haven't been worthwhile. But undoubtedly, AI is here to stay and will make a lot of money in the long term. I'm aware of a number of different arguments in terms of some of the debt that they're going to get into. We're now seeing OpenAI really coming into the limelight, considering the amount of funding that they're going to need and whether they really have anything to obtain that. I mean, ChatGPT, yeah, you can subscribe to it, but how much are they going to make off of it? Then question marks around the energy production, whether that's possible. Question marks about the sort of bookkeeping around the sort of deterioration of assets over time from Michael Berry. Look, there's plenty of arguments here, but essentially in my mind, I think as long as the earnings keep coming out strong, we can get pullbacks over sort of fearful periods. Does that justify a market collapse? I don't necessarily see it personally, not yet. So that's why I was really interested to see if we see a sign of a bottom here. And that's exactly what has happened now, because crucially, just at the sort of back end of this week just gone, we have broken up through your first swing high, 25224. That in my mind, I mean, if I was to say the safest way to play this, that in my mind means that this move is less likely in my mind than this move, right? I think it's more likely because we've broken through that swing high. it's more likely that we reach record highs than if we break back below that price swing low. We would essentially need a major collapse in this market for that to happen. I don't see it. I think that the dip has been set. And if we do see a period of downside coming into play, then that looks like a retracement rather than a sell-off that would break through the price swing low, and in which case we'll be looking at that as a potential area for the bulls to come back into play. But I think that the bulls are back into play. You can see it here. We're looking to end the week sort of, breaking through resistance. If we do see a pullback, like I said, it's not a problem. Ultimately, at sort of tops and bottoms, a lot of the time you will see that, right? You don't just go lower high, lower low, and then just go straight up. A lot of the time you'll go lower low, higher high, into the higher low, and then you see the bulls coming back into play. So whether that comes into fruition remains to be seen. But certainly as we come into this week and a big focus on the US data, if we see inflation under control, that should embolden the bulls, particularly around the tech sector. And that's why I'm looking at the Nasdaq. I think that's a key one to be watching out for the week ahead. Next up, let's look at the outlook for the eurozone. Bear in mind that the key reason why I'm showing you this is that we've got inflation coming out, and markets are predicting a decline in terms of the core, a 0.3 decline on a monthly for the headline figure. And so I guess it's a question mark of, there's all this talk of essentially that it's over, the easing from the ECB. Is there going to be a justification for further easing? Notably, I was going to put this on a slide, but I can just read it out to you guys, right? Notably, we have seen a raft on Friday, as I record this, we've seen a raft of inflation readings already come out from different regions, and that all sort of feeds into what's happening in terms of that eurozone figure. So the inflation figure for France came in at minus 0.1. Markets were expecting 0.1, so significantly lower. The monthly inflation figure for Spain came in at 0.2 as expected. Germany came in at minus 0.2 as expected. Inflation for Italy, minus 0.2. Markets have been pricing 0.1, so a significant decline on that front. So 2 out of those 4 major economies within the eurozone have seen inflation below expectations. That points in my mind towards the high possibility that we see a similar kind of thing this time around, and that we see further weakness in terms of inflation. You can see here, we ultimately see with the eurozone this sort of spread in terms of where inflation rates are elevated in terms of Spain. Let me just see this here. So it's more elevated in terms of Spain. That's roughly 11% of the eurozone reading. France, 20% of it is at like 1%, so really low. So France is dragging the eurozone figure lower. Germany at 2.34. That's roughly a third, so 28% of the CPI metric. Italy 1.16, but it's not as influential. So that is 16%. So if we look at the readings that essentially have just come out and come in lower than expectations, you could say it is the French one and the Italian one, right? So essentially with that, you're looking at the Italian and the French. The French carries weight, the Italian less so, but all in all, it points towards a potential for a weaker than expected figure on the eurozone. Of course, there's more countries than this, but these are the sort of more dominant ones. In terms of the outlook for inflation, we can see here that sort of CPI on a 6-month annualized 1.4, the core CPI 6-month annualized 1.8. So we're tracking on a pace that is below 2%. It does essentially signal the possibility of further easing if need be, but really it's a question mark in terms of, are they going to sort of leave some fuel in the tank? Do they think what they've done already is enough? So let's look in terms of here we go. Let's look in terms of euro sterling. It's one we've followed a lot. And so here we go. So this is your wider trend. And we've been looking at this with a bullish view throughout the entirety of this year. And certainly, it's worked out really well. Notably, we've been coming into a little bit of downside here. And we've, of course, seen the UK budget and the like. So there's been some volatility coming into play. But I think, that narrative around the Bank of England easing is likely to stay. I think the ECB, do we see an additional rate cut or not? I mean, I thought I'd added it to the deck here, but I hadn't. So let me just quickly bring that up for you so I can at least read out exactly what the view is. So yeah, I mean, markets essentially very confident that we won't see an additional rate cut as things stand. 96% chance that we pause in December, 95 in February, 85 in March, 80% in April. So obviously, as you go further out, there's more indecision because people don't necessarily know what the economic conditions will be like. But markets are very confident that they're done. And so this pullback that we're seeing at the moment, I think, is likely to be short-term in nature. Do we see trend line support coming into play here? And that is the catalyst that sees the pair turn upwards once again? Not sure, quite frankly. I mean, I'd probably say, I'm not going to hang my hat on it. Probably say look out for sort of short-term intraday price action and see exactly how that's shaping up. So this is the hourly time frame. You can see here that we've sort of seen that sharp decline, then consolidation. It's a difficult one because that swing high up here is very far away, which is not ideal, frankly. If we start to break up through this areas of 877, I wouldn't necessarily say that's a absolute given signal that this market's bottomed out. So let's see how we respond to trendline support, see how sort of price action shapes up. It might be a case of like we rally into a higher high above this area, and then pull back into a higher low and then break up through there, and then that's your signal. So different ways of playing it, but I do think that we're likely to see further upside coming into play for euro sterling as the Bank of England prepare to ease in December and the ECB likely pause from here on in. But if we see particularly weak inflation data coming out of the eurozone, maybe that could embolden some euro weakness over the near term. So certainly one to watch out for the week ahead. And finally, let's jump onto this chart. So this is the Canadian data. Of course, there have been big question marks around Canada. They're so heavily reliant on their relationship with the US, and there's question marks around that. And the data's not been great. This week, we've got the manufacturing PMI on Monday. We've got composite and services on Wednesday, the IV PMI on Thursday, and then the jobs report on Friday. Forecast of a rise in unemployment up to 7%. Employment change down to just 10K, participation rate flat, average hourly at 4%. Look, ultimately, it's a question mark of whether we're seeing weakness coming into the fore here for the Canadian economy. And certainly, if we're looking in terms of the unemployment rate, it's very clear exactly the direction of travel for unemployment, which is not necessarily the norm when it comes to being outside of a recession. You can see here, I've got those gray bands for previous recessions. And that's when you see the protracted upside in terms of unemployment. This time around, we've not seen a recession, but we have seen the resurgence in terms of unemployment. It is a troubling sign, but the Bank of Canada have already sort of taken their action. We're not expecting, according to market pricing, another rate cut within this cycle. That might change if we see a significant deterioration. But much like the euro, it sort of signals the possibility of them keeping rates steady from here, and therefore you sort of play that differential against a central bank that's likely to cut rates. You can see here the impact of Donald Trump coming into power. We've seen a sharp drop off. Bear in mind, this is indexed to the beginning of 2025. So essentially that 100 mark, as you can see on the right, is the point at which they're equalized. But you can see that much sharper decline in terms of exports from Canada to the US versus US exports into Canada. So they have been suffering, unemployment on the rise, exports hit hard, and markets are pricing rates to essentially stay steady. But there's some indecision towards the sort of second half of 2026. And that's understandable because essentially we don't necessarily know what direction the economy is going to go in or prices. And of course, the economy is not in great shape at the moment. So there's question marks on whether they need to do more. But right now, that's not necessarily something that is the base case scenario, which points towards the possibility of some strength for the Canadian dollar. The caveat is if we see particularly poor jobs data on Friday, maybe we do see some weakness coming into play for the Canadian dollar. But here's the chart to watch out for. Just wanted to show you the chart for the US dollar against the Canadian dollar. We've been regaining ground here, but like I said, as you see this period where the Bank of Canada is easing, but the Fed are keeping rates steady, so you see the strengthening of the US dollar, the weakening of the Canadian dollar. But now we're seeing that inverse. And you're seeing the possibility here of a double top formation. The breakthrough 1397 completes that formation and signals a potential top here for dollar CAD. The 4-hour chart looks something like this. I mean, ultimately, I just think, this is probably one to be watching out for in terms of that 397. If it breaks, then, I think that's a really interesting signal for this market. Now, you could say, well, this is a retracement before you then break higher, but we didn't break through the prior high, which is true. So you could say this is a sort of multi-legged retracement. I just don't think that's the case, because a lot of the time when you see a sort of ABC style retracement, as with Elliott wave theory, this retracement won't come anywhere near as deep as that. It's come so close to the top, it looks very much like a double top formation. So yeah, I think this is a really interesting one to follow. Of course, if the data is particularly poor, maybe we do see some additional weakness in terms of the Canadian dollar. And of course, there's plenty else going on around the world in terms of things that are going to influence the likes of the US dollar and the like. Core PCE, of course, being one part of that dynamic. But nonetheless, this is going to be a key market to be watching out for, because I think there's a good chance that this rally that we have been seeing is likely to come into a more bearish phase as we move into a easing process for the Federal Reserve, or as we move through the easing process, while also factoring in the possibility of a very dovish shift as Donald Trump appoints his own governor. And then you've got the fact that the Bank of Canada, by and large, are done now, much like the eurozone, and that forms the basis of potential differentials in terms of the yields playing out versus those countries that are easing, like the UK, like the US, and therefore strengthening in terms of those currencies, strengthening in terms of the likes of the Canadian dollar, the euro, and then weakening in terms of the US dollar, the likes of the pound. That's how I see it. Hope this has been useful. Make sure to like, subscribe, and follow for more. My name is Josh Mahony, Chief Market Analyst at Scope Markets. Have a great day and a great week ahead. Thank you.